We told you about it. PCE jumping 0.2% last month, which is just what the street was expecting. That number is up 2.5% from the same time last year, with core prices rising just about the same amount in that time frame. And while inflation fears they may seem to be easing, the consumer still feeling the pain, especially at the grocery store. Take a look at staples like eggs, milk, yogurt, beef, and bread. Those prices ticking upward from this time last year, with some over $1 higher than July of 2022. So let's talk more about the Fed's fight against inflation and the health of the economy, the consumer, and the size of that first anticipated rate cut in September. I'm joined now by Mark Zandi. He is Moody's Analytics chief economist. Mark, thanks for being with us today. I'm so glad that we showed that wall because it does put it into perspective. It tells us what the stakes are here as well. Of course, everyone, the market is expecting its first rate cut at that September meeting. Mark, what is the risk first, I guess, in moving too quickly here to cut rates?
Deirdre, I don't think there's much risk of moving too quickly. I think the Fed's been too slow to respond. I think rates have been too high for too long. So I'd get going. I mean, they've hit their mandates. That would be full employment. We have a 4.3% unemployment rate, which has been edging higher and is on the soft side of full employment. And inflation, with today's inflation reading, that's within spitting distance of the target. And I would say, you know, if you exclude the implicit cost of home ownership, the owner's equivalent rent, which I think you should when trying to judge inflation in terms of what it means for monetary policy, the inflation rate is already well below target. So, you know, full employment, inflation at target, 5.5% funds rate is, which is where we are today, is just too high. They should be cutting rates.
Okay, so how quickly should they be cutting rates, Mark? I mean, are you expecting 25 basis points in September? Do you think that there's room for maybe a 50 basis point cut between now and the end of the year?
Well, I think they'll cut a quarter point in September and probably again in December, a quarter point and go, quarter point each quarter going forward until we get back to what you might call the equilibrium rate, that rate at which policy is neither supporting or restraining growth. You know, I think they would reserve a 50 basis point cut, a half point cut to environments where there's something that feels like it's going off the rails. You know, if you go back to the market turmoil of a couple of weeks ago, if that had continued, then that would be the fodder for a 50 basis point cut. Or if the job market really started to weaken, unemployment started to rise in a significant way, that would be the fodder. But barring that, then I think they go slow and cautiously in cutting rates.
So we are going to be getting a jobs report next Friday. What would a bad report look like to sort of make the Fed take pause, or would it just be one data point?
I think one data point, you know, the August employment number is particularly problematic. If you go back in history, it always comes in really weak. And I think it goes to just the low response rates in the month of August because businesses are, you know, people are on vacation. And then subsequently you get these upward revisions to the data. So even if you got a soft number, even a negative number, you know, I'm not sure that would be enough to push them to go to 50 basis points. But I think it would be just one number in a slew of things that they're looking at.